You are 27 years old and good at your job. Your managing director now steps out of the room when you present because he trusts your numbers, which means you sleep better than most around you. You cover mid-cap industrials at a mid-sized asset manager in Chicago, managing $3.6 billion across 55 positions, with 7 under your responsibility. Every morning before 6 a.m., you open your 3 screens and review earnings releases, management commentary, and sell-side reports that ultimately say little. You have always believed the market is a mechanism for price discovery, and that your job is to find where it breaks, but that belief is about to shift. The call comes on a Wednesday in October, just before market close. It is an unfamiliar number. The voice is calm and surgical. He introduces himself as Garrett Whitmore, representing a family office managing just under $2.8 billion in private assets. The family owns 19% of Arden Industrial, one of your core positions, and he wants to meet before Friday's earnings call. You go. The office in the West Loop has no signage and requires a key card for both the elevator and the floor. Whitmore, in his early 50s with slight gray at the temples, wears a white open-collar shirt with no tie. He pours water without asking and places a folder in front of you containing your last 3 notes on Arden, carefully marked up in blue ink. The family bought Arden a decade ago at $5. It now trades near $34. He says they have no plans to sell. You reply that with nearly a 6 times return and the stock fully valued, they should lock it in. Whitmore looks at you like you have missed something obvious and asks you to walk through the tax, federal capital gains at 20%, net investment income tax at 3.8%, and state tax just under 5%. On roughly $240 million in gains, that means $65 to $70 million gone in taxes permanently. You say it is simply the cost of taking profits. He replies calmly that it is a cost they choose not to pay. He slides a term sheet across the table showing a $160 million lending facility at 3.6% with no tax event. Liquidity is created without selling, and the asset continues to compound. You pause. He says their goal is to never need to replace a great asset. You take the engagement even though you do not fully understand yet, and that is where things begin to change. The first year is technical. You work on structure, not traditional portfolio allocation. Real estate is held through layered LLCs for control and protection. Equity positions sit inside trusts designed to reset cost basis at death, erasing gains for the next generation. They hold stakes in private credit where income is taxed more efficiently. Every asset is chosen not just for return, but for its tax behavior and borrowing power. This is no longer a portfolio. It is a system built to generate liquidity without triggering the destructive event of selling. One night, you model 2 scenarios. In the first, the family sells Arden, pays the taxes, and reinvests at 8%. In the second, they borrow at 3.6%, hold the asset, and let it compound. Over 25 to 30 years, the difference is massive, more than $250 million. Purely from avoiding the tax event. The returns are the same, but the outcome is completely different. The math is simple once you see it, and you finally understand why no one talks about it. In the second year, you meet another family with older multi-generational wealth. Their assets include toll roads, energy distribution, and cell towers that produce steady cash flow every month in almost any environment. They call it permanent income. In one meeting, they receive a $600 million offer for a water utility, a strong multiple with an original cost basis under $20 million. The patriarch does not ask about the buyer or valuation. He only asks how much they can borrow against it right now. The answer is roughly $250 million. He nods and says, "That is enough to fund the next project." To him, selling is not an opportunity. It is a loss of control. Every asset represents a long-term claim on cash flow. Selling converts that into temporary taxed money that can be spent or misused. That is why they avoid it. You walked in thinking about exits. Now you think in terms of permanence. By the third year, you are actively building. A founder with over $1 billion tied up in a single stock approaches you. He cannot sell without crashing the price and triggering a massive tax bill. You structure an exchange fund where he contributes his shares, defers the gain, and gains diversification. It takes months and costs over $2 million in legal work. When it closes, he calls you from somewhere on the water and says it feels like he has unlocked a different level of the game. Your perspective fully shifts. Leverage is no longer risk, it is access. Assets produce income and borrowing power that funds new assets, creating more borrowing power. The holdings form a lattice where each piece supports the others. Selling one weakens the entire structure. You stop thinking in individual investments and start thinking in systems. By the fourth year, you help defend one of these systems. An activist investor pushes for the sale of real estate to unlock value. On paper, it makes sense, but that real estate supports multiple credit lines across the group. Selling it would create pressure everywhere else. You redesign the structure with isolated risk, non-recourse debt, and a narrative focused on stability. The activist backs off, and the system remains intact. By the fifth year, the illusion is gone. You no longer see stocks or deals. You see architecture. Every asset serves three roles at once: generating cash, supporting borrowing, and minimizing tax exposure. They are not chasing returns. They are designing durability. The wealthy do not avoid selling because they are greedy. They avoid it because they have built systems where selling is unnecessary and often damaging. Liquidity is created, not taken. Taxes are delayed, not triggered. Wealth compounds because the foundation is never disturbed. You started your career thinking success meant finding the next big opportunity. You end up realizing the real advantage is never needing to look for one again. You spent years thinking about when to exit, while they spent generations making sure they never have to.